Good afternoon, everyone. This is Debashish here. I look after the products function at DSP Mutual Fund. Today, we'll discuss about investing in international markets and possibly using domestic mutual funds to accomplish that. Now, before I get into international markets and what funds to maybe look at, I think it's probably good to get a little overview of international markets. And I think what has happened with this COVID-19 episode through this year is that it has brought to the fore how interlinked markets are all over the world. We've seen equity markets all over come off dramatically. We've seen bond yields go down dramatically all over. We've seen oil prices crash. And what one can see is you have similar things happening around the world. You have similar things happening across asset classes. And that's a very, very important takeaway. So when thinking about international markets, it is complex. It has a lot of moving parts, and therefore, before you also venture into investing in the same, it's good to understand the background about that. This question from a slightly different angle, and I'm saying I don't necessarily think so that it makes sense for someone to take exposure or not. I think it is very dependent on someone's circumstances, and that too after a good understanding of what are the risks involved. All said and done, it's a little easier to evaluate risks within your own country. And investments, a lot of investments is about first understanding the risks and then trying to figure out what the returns would be and then going ahead and investing. So when we look at international markets, the sort of risks one has to be aware of is that what we see is only one part of the overall puzzle. What we usually see, what we hear about is how a particular equity market did in some part of the world or not. Equity markets is actually the smallest part of the overall financial markets. It's also the part which is more influenced by sentiment than anything else. We have the bond markets, which are about 3 or 4 times the size of the equity markets and which exert a massive influence on what happens in reality. We've got the currency markets, which are even larger and which are a very important thing when looking at international investments because you are investing in different currencies. And therefore, the fortune of the currencies has a big role to play in the prospects of your investment. And then on top of that, you've got something called the derivatives markets, which take their values of what's going on in the underlying markets. But unfortunately, in today's day and age, they tend to be several times larger than the underlying equity markets, for instance. And therefore, their influence, while it's very hard to figure out if you're not someone who is a full-time financial professional and involved in these activities, but their influence is outsized in terms of these markets. So I'd actually go with the opposite sort of, caution kind of approach into international investing. Having said that, there are obviously opportunities, and specifically if you happen to be somebody who has businesses which are involved in imports, exports, and therefore you have exposure to different currencies, it's something for you to look at. If you happen to be somebody who is potentially, sending your kids abroad to study and you will have a big dollar liability, for instance, coming up, it's something for you to look at. It could also be that you happen to have a set of exposures within India and you want to diversify your exposure in terms of the currency which you're exposed to. And the fourth case could be where you're looking at specific opportunities which are just not available in India. So when we put that together, you could then from that, derive what is the reason why you should invest. But again, it's very specific to your individual situation. I would typically go with an 80-20 kind of allocation where say 80% is dedicated to investments in the domestic markets and 20% is probably what you put to work outside of India. But the way to look at the allocation, we've got a slightly different framework. What we try to do is separate your investments into 4 buckets. The first bucket is where you're looking at capital appreciation. The second bucket is where you're looking at income generation. The third bucket is where you're looking to find something which is able to hedge the volatility in the market. Let me just explain what I mean by that. Markets have a tendency to go up and down. There are certain phases where they tend to go up and down a lot more compared to other phases. The last 10 years was a period where they did not go up and down too much. They were relatively smooth. Smooth markets makes it much easier for you to hold on to your investments. But the phase we are entering in today and starting from this year or is going to be far more volatile, far more turbulent. There'll be a lot of issues coming up from time to time, which can make the market swing dramatically from one side to the other. We've already seen that through the course of this year. These situations make it extremely hard to be able to hold on to your investments. So therefore, a percentage of the portfolio is also dedicated towards hedging the volatility. The fourth part is really looking at providing a hedge for future inflation. Inflation is the bugbear of all investments because the whole point of investing is lost if there is inflation. Because what inflation does, it eats away on your returns at a rate faster than what you're able to generate it. So in those circumstances, you have to look for something which will give you a rate of return faster than the speed at which inflation is happening. Inflation doesn't seem to be an issue right now, but it's something again to be mindful of. When we take these four buckets, again, how you allocate between them depends on your circumstance, your age, what are the kind of cash flow requirements you have, what are future growth requirements, what is the sort of length of the future which you have ahead of you. So these are things you should work closely with your advisor to figure these out. Within that, if you are to then figure out where to put money, if we typically what we tend to look at is the first bucket, which is capital appreciation, where let's say the typical thing is, okay, let me put some money into stocks in the US, or let's say buy a Nasdaq ETF or something like that. That really would figure into the capital allocation, the capital appreciation bucket. You could follow a similar 80-20 split within that bucket. So let's say out of your 100% of the portfolio, let's say you allocate 30% to capital appreciation opportunities. So out of that, say put 80% to opportunities within India, 20% to opportunities outside of India. The similar mindset you could follow for each of these buckets. Investments which we have today going into international markets are unhedged. What that means is that you have an exposure to the currency of the country or set of countries which you're taking an exposure to. So, for instance, if you're buying a fund which is investing into stocks in the US, we have one of those funds. It's called the DSP US Flexible Equity Fund. So over there, you're basically taking an exposure into dollars. So therefore, whatever happens to the dollar versus the rupee is also reflected in the returns which are obtained in your fund. Typically, we've tended to see that, let's say, the dollar tends to appreciate about 3-4% a year versus the rupee. This may not always hold true, but it has held true for a fairly significant number of years. So to that extent, that much of extra returns are added into your portfolio. You could have another fund which is investing into China, for instance, so where you're effectively taking exposure on the yuan. We actually happen to have a fund which is investing across the world, where let's say roughly about 60% in the US, but then the balance is around Europe and Japan and Asia and all these places. So there you tend to have a little bit of a mix of exposures from a currency point of view, where say 60-70% is effectively dollar exposure and the rest could be euro and yen and things like that. So very important thing to keep in mind when looking at international investing. The benefit of that can also be that the funds which we have available domestically, which invest abroad, they are from a tax point of view, they are treated the same way as debt funds, which means if you hold it for 3 years, you get indexation benefits. So potentially you could be investing into a market abroad, but you would get indexation benefits from a higher inflation country like India into the final returns which you make. So therefore you're able to index it at a much higher level of inflation versus, let's say, if you were to index it versus inflation levels in the US, where you're typically investing your. So that's something to keep in mind, and definitely do reach out to your advisors to try and understand this concept better. Now, rule of thumb typically is that what you have to have some sort of sense of what is going on around the world, and accordingly, which asset classes will perform or not. So let's just run through what's happened over the last, say, since the time this millennial began, from 2000 onwards. Let's look at equities, bonds, currencies, and commodities. And from that, we'll be able to understand really how things have done and what potentially you could look at in the future. So if you look at equities, for instance, we had the first decade, which is almost till about the global financial crisis back in 2008. In that period, the emerging markets, including India, performed very well, uh, whereas the more developed markets, especially the US, tended to underperform significantly. This was, in fact, following a period of about 4 or 5 years prior to that, where the US markets did very well, especially the technology uh, stocks, which ended with the crash in the NASDAQ back in 2000. So that was the story of the first decade, if you will. Post that, post the global financial crisis, it's actually been the US which has done extremely well. It's also been where the Federal Reserve has printed a whole lot of money, which in turn has helped push up valuations. So the US has tended to do very well, and within that, what has specifically done very well is what's known as the FANG stocks, which is Facebook, Amazon, Netflix, Google, all of those companies you're very familiar with, and that's contributed a large part of the returns and tended to outperform everything else. Let's look at bonds, for instance. Bonds again, especially after the global financial crisis, where interest rates came down significantly, investors all over the world who are seeking income, especially you have these pension funds, etc., who have to give a certain rate of return to their claimants. For these people, it was harder to generate returns just out of, say, government bonds in the US, for instance, which were yielding much lower. So they would seek investments which are yielding higher returns. These typically tend to be corporate bonds, and especially what is known as high yield corporate bonds, which is companies with a little shaky fundamentals, and therefore you are able to charge a higher rate of interest when you give them a loan, or when they issue a bond, they have to issue it at a higher rate of interest. So those are the kind of places where money has gone into. So again, you see this tale of the story seems to change from decade to decade as different things become available. Take gold, for instance. Gold had a little bit of a run through the first part of the previous decade, which is between 2003 to 2006, and then sort of started taking off quite a bit. Then went into a big correction in the period from 2007-8 or so, and then again from 2009 onwards had a big rally all the way till 2012. After that, there was like 6 years of wilderness where gold prices effectively almost halved, and then again from there we've seen a significant rally over the last year and a half. So these patterns keep changing, driven by multiple factors, which we'll probably not try to get into over here. Take commodities, other commodities, for instance. Let's take industrial commodities like copper, etc. Industrial commodities did very well in the first decade, largely driven by growth in China and other emerging markets. And then when we look at the previous decade, they have underperformed significantly. Similar story repeated in agricultural commodities, where in fact the underperformance has been much, much longer. There's almost been a 30-40 year period where they've actually not done anything. Now, because these things keeps changing from time to time, let's also look at currencies. I missed on that. On currencies, we saw the first decade where emerging market currencies did very well, and then in the second decade, which is post the crisis, the dollar has tended to do very well against emerging market currencies and also against the euro and the yen to that extent. So when we look ahead, I think while the initial part of this decade could see the dollar appreciating, it could see US markets probably again outperforming the others. But then post that, you could have a phase where all of this turns around, where you could actually see commodities which have not done well for a very long period of time start to perform extremely well. You could see gold also perform significantly after possibly seeing a big correction in between. And it's possible that if the dollar does very well now, but looking forward, the rest of the decade, we might see again changes in that. So be aware things do change, and therefore there is a need to try and understand what's going on around the world from a global macro standpoint, and then take a call where you want to invest in. The markets are very complex now, and a bunch of reasons for that. Most important one being that you have central banks participating in a massive way around the world to try and stave off an economic depression. Whether they succeed or not is a different matter. But what it means is that a lot of financial market, the ability of the market to try and come to a price of an asset, that whole process, which is why a market exists, has got distorted because of the prevalence of this one big actor who can effectively keep printing money. When the ability of the market to price an asset is distorted, it is extremely hard to come up with uh, objective valuation measures, irrespective of which asset class you're dealing with, whether it's stocks, whether it is bonds. It's just hard to figure out how to value something. And when you can't figure out how to value something, effectively you are speculating. When you are speculating, then you need to be aware that things can keep changing from time to time, circumstances can keep changing. And over here, more so because the rules of the game can keep changing in terms of how the governments, how the central banks react. So one will have to almost keep adapting to the situation if you want to be participating. And this is going to be true irrespective of which market you invest in, whether it's India, whether it's abroad. Especially if you're a first time investor, I would possibly suggest that you stick to India and try and understand the flow of the markets, because it's a very, very different regime than what we've seen over the last 20 years. Stay safe, and that's really it from my side. Thank you.